Despite lingering headwinds from tariffs and uncertainty related to shifting geopolitical tectonic plates, global economic growth has remained resilient. I am Morin from CIBC Asset Management. Welcome to the winter edition of Perspectives. The global outlook for growth is constructive for 2026. We do have tailwinds that should support the global economy. We have a global tech cycle that should remain strong. There is strong military investment in several countries, including the US, Japan, Germany, and China at some extent. There is also a global fiscal stimulus in several economies and monetary policies that should continue to support growth. We also see the emergence of a manufacturing cycle that should support risky assets. So when we combine everything together, we do have a macro landscape that is constructive for risky assets. As a result, we do recommend to keep overweight position in risk assets such as equities across all markets, at the exception of Europe, where we are neutral, where we believe that most of the fiscal stimulus story is already in the price. And also, it's important to keep in mind that Germany is facing some structural impediments related to the rise of China in the EV sectors. US growth should remain resilient despite immigration policies and tariffs. So we have a US economy that is slowing and growth outside the US that should improve. And that combination is compatible with a weaker US dollar. The US dollar is overvalued. The Fed is going to cut further its policy rate, while in the rest of the world, rates will remain unchanged or increase in certain cases. Furthermore, there is a growing appetite by foreign investors to diversify their excessive reliance on US treasuries in a context where the US is facing the negative trade balance, elevated fiscal deficits, a booming debt, and there's also concerns about the independence of the Fed or the inflation risks over the long term. And those risks, coupled with a changing world order, is resulting in a slower demand for US treasuries by certain long-term investors outside the US and especially in the emerging market. What will put a floor on the US dollar depreciation is the fact that we see limited upside on the euro. The euro is the anti-dollar. So it's important to keep in mind that there is no real substitute to the US dollar. The US dollar is and will remain by far the global reserve currency because of the breadth and the depth of its financial system. And that's why gold prices are booming, because long-term investors are looking for gold at the margin, and we remain long gold prices and long assets that are sensitive to gold prices that include Canadian stocks. We believe the growth outlook is constructive for risk assets. It's difficult to predict what geopolitical forces will give us. And as a result, there is a new form of uncertainty that was not present in the past. And so in that context, it's important for investors to keep a good diversification of their portfolio, but also to make sure that the portfolio is well designed. And by well designed, I mean that it doesn't have unintended exposure to those risks and is compatible with you as an investor being able to achieve your long-term objectives. For the full Winter Perspective report, please visit the CIBC Asset Management Insights Hub.